Good morning, everybody. Wow, this is a special day. I'm not going to lie that I've been looking very forward to this day. A couple of reasons for that is that I myself have an accounting background. I studied at university, never went very far with it. I've been an entrepreneur all my life, but for the last 15 years, I've been in the sustainability space, and I've applied that same logic and rationale that I learned in accounting to the sustainability space, and it doesn't really fit, or it hasn't to date. So this discussion, why I'm so excited, is it represents really the convergence between, I suppose, traditional, conventional, financial, commercial business, and this whole massive subject called sustainability. And much of the battle that I personally have been having over the last 15 years, being in the sustainability or the corporate sustainability trenches, has really been one of the big challenges has been the mindset of the CFOs that I've had to encounter during this time, the person with the purse strings and the ear of the CEO. And his job it is always to ensure that profits keep flowing and are maximized for the benefits of the company and its shareholders. And and often what's happened is that they have dismissed the environmental, social governance issues, calling them softer issues. Well, these soft issues have become considerably harder over the last couple of years, and things are definitely changing, mostly as a result of mounting pressure from investors, financiers, consumers on companies to prove their credentials for investment finance, or merely just to buy the company's products. The only way to do this is through accurate disclosure and transparent reporting around a company's ESG performance. This discussion represents that convergence that I'm talking about, because this has been the responsibility of the CFO and the CFO's office to date. I'm not going to run through the profiles of the people. I'm going to get right to it. We don't have a long time to chat about this. But what I must say about the three individuals who are panelists in this discussion is that they bring completely different lenses into the same profession, the accounting profession. First, we have Loshni Naidu, who's the Project Director for Sustainability, Integrated Thinking, and Integrated Reporting at the South African Institute of Chartered Accountants. Welcome, Loshni. We have Sean Doherty, the Chief Financial Officer of Transaction Capital, and himself a student, a PhD student in ESG. And then we have Professor Warren Maroon, who's a professor of the School of Accounting at Wits University. Just so before I begin, if you have any pressing questions, please just type them into the chat box on your Zoom, in your Zoom app, and let us have them. The lovely Marissa will send me questions as they come through, and I'll select the ones that I have time to cover before the end of this discussion. To the panelists, we don't have a lot of time. Let's keep the answers concise and to the point, and please don't take it personally. If I do interject, I'm just trying to keep things tidy and on time. So let's get going. I'm going to start with you, Loshni, if you don't mind. Okay. Listening to our clients, one of the major barriers to them doing more around ESG disclosure is the fragmented nature of the ESG reporting world. The requirement to either report or to align with so many standards and frameworks is becoming a bit overwhelming for companies, both in terms of human resources and in terms of cost. Question to you, Loshni, how do you see this all coming together and converging, if at all? What is your view on this?
Morning, Kevin. Morning to everybody joining, and thank you for having me today. So if we look at what's happening globally around the EU Commission and the release of the various potential standards. So it's out for comment, and we see the work coming out of the IFRS Foundation in terms of establishing a sustainability standards board and potential standards out next year, specifically the climate one. I mean, the first point of departure is we welcome it. Like you said, it is a burden for most companies, large or small, from a resource perspective, trying to report on the same information in various different formats. So I think it's a welcome, firstly, it's great that there is now consolidation, rationalization around all of these reporting frameworks. But I think where we're at is almost a wait and see to see how this is going to play out and what this is going to look like and what are the impacts and the potential impacts for companies with dual listings, whether you have operations in the EU, listed in non-EU jurisdictions, and if you're working in IFRS related jurisdictions, what is this actually going to mean? So I think where we're at, it's great that it's happening and it's moving at a pace that's been unprecedented. But I think there is some caution when you have conversations around how this could play out. Thanks,
Thanks,
Kevin.
Lashni. Moving over to Warren. Warren, while I was reading up on your profile and doing a little bit of stalking and research, I stumbled upon a WITS short course titled Integrated Thinking and Value Creation, and you're providing a certificate of competence to people completing that course. This looked really interesting and looked on the money, so to speak, or on the value, so to speak. But my question to you at the WITS Accounting School is, in terms of your bread and butter graduate and postgraduate courses, how are these being adapted to prepare your students to becoming the CFOs of the future, or the CVOs of the future, as the phrase has been coined by yourself and Professor King?
That's a great question. So, I mean, as we've been discussing previously, we're not saying that the role of the accountant and the role of the financier is diminishing. And we're not saying that accounting and finance no longer play a key role in the value creation process, and that these things have become secondary in the way we think about business, the way businesses are conducted, the way businesses are managed, and the way businesses are reporting. But the position that we've taken is, let's use that very strong accounting and finance base, which most of us as accountants and financiers are comfortable with, and let's build on that to create a multi-dimensional perspective on the way value is created and the way companies ought to be managed, ought to be run. So I often say to people that at the undergraduate level, we teach our students to think in 2 dimensions. We focus on the idea of financial capital and the idea of manufactured capital, or if you prefer, on the rands and cents of the transactions and the discount rates that we need to use when we're dealing with future cash flows. And we start taking that 2-dimensional model and we build into it by saying, well, let's think about the social and environmental issues that might affect those cash flows or might affect those discount rates, or do both. And as we begin to move into the higher levels of study, we start introducing additional dimensions until the point where we get to the postgraduate level, where we're starting to deal with people who have a wealth of practical experience, have already gotten their hands dirty with the practicalities and with the realization that things don't go the way they should according to the textbook. When you're dealing with those kinds of people, you can then say, all right, well, let's take that 2D model and let's expand it now to deal with the remaining capitals. Let's start working in 6, 7, and 8 dimensions to think about how we can actually generate value and move towards a more sustainable approach to doing business. But of course, that's something that takes time. Integrated thinking, this concept of value creation, is not something that you can cover in sort of a 2-week crash course and say, oh yes, now I'm an expert in it. It takes a long time to build those competencies to get people to fully understand this idea of integrated value creation and this idea of the value officer.
Thank you. That's a great answer, Warren. Thank you. I'm going to jump over to Sean, and I always I find Sean's profile particularly interesting because of his being CFO of Transaction Capital, a very successful and hard-nosed, I suppose, financial organization financing assets for South Africa. But he also has been studying. He's been studying and completing his PhD in ESG, and this really flagged. You know, he was flagged on LinkedIn when I saw the profile because. Sean, I want to know from you, you're fortunate enough to have seen the reality in terms of your job at as CFO of Transaction Capital. You are also in academia. In terms of what Warren's just said, how divergent are what the textbooks are saying from what happens in real life and in the boardroom? And the next question following on to that is, in practical terms, because I have seen your sustainability report, which I really thoroughly enjoyed, how do you manage ESG in your business? Where does it sit? What does the structure look like? And who is ultimately responsible for it? And is this aligned with what you're learning in academia? Sorry, a lot of questions, Kevin. There. My apologies.
No, sure. No, thanks, Kevin. So at the moment, I'm actually doing that CVO course that Professor Maroon is running, and hopefully that will be my on-ramp into a PhD. So I did the first one, and we're busy with the second one in governance at the moment. So are the ideas of academia competing with the practicalities of the boardroom? And I think in certain issues, I wouldn't say they're competing. I think in certain instances, maybe they are a little bit too theoretical, and it is difficult to sometimes draw the line from what a professor writes academically into the boardroom. I think integrated thinking, by way of example, is one of those. It's not a new concept, and I do think of it a little bit more simply in terms of I just think it's all about strategy and how over time you make certain decisions. If you make those decisions consistently, and you can demonstrate what that sort of looks like, I guess that is integrated thinking in a way, and that should find its way into integrated reporting. So the aspects of this of these things have been around for a long time, and I think corporates do them very, very well. There are a number of integrated reports which I think are excellent. I would imagine they are some of the best in the world coming out of South African companies. The question mark I have often is that just because they have very, very good reporting teams, or are people living this in their day-to-day? So are you reporting on what somebody wants to see? And we all understand how integrated reporting works. There are capitals, there are business activities, and you sort of have outputs. And some of the reports, and I'm hypercritical of ours, including ours, sometimes are a little bit academic in how they look at those things. Or are you actually living that, and are you using these mechanisms and frameworks to drive the change which we need? So my sense is very few corporates are doing the latter. And I think we need to improve on that. And I think we will improve on that over time as a sort of a corporate South Africa. How it works in our sort of world of transaction capital, we've got an executive who is responsible for, we call it governance and sustainability. Again, governance for us, the foundation of everything, and you build on top of that. So we don't separate these things. The lady named Marika, she reports into me, and I guess between the two of us, we drive all sustainability initiatives. I think of sustainability as broader than just ESG. I think ESG are components of it. As I say, the G is the foundation. I think sustainability does talk to sustainable growth, which talks to things like innovation. And then clearly we have things like environment and social, which in all contexts are critical. In a South African context, you could argue even more critical that we get these things right. So we do it out of the office of the CFO, I guess you would call it, but we pull in across the company. So we definitely don't do it by ourselves. The nice thing about transaction capital is a lot of the economic drivers are not dissimilar to the social drivers. So there's that alignment in our space, which I think is, well, it's not fortunate, it's by design. It's absolutely by design. We do think you can make money, and absolutely we are hard-nosed businessmen. We've made really, really good returns for all stakeholders, not just shareholders, over the years, and we've done it because we think we are relevant to society.
Thanks, Sean. I'm going to go back to you, Warren, if you don't mind answering a similar question. If you had to say, ideally, where and how ESG and sustainability should sit in an organization, because we come up, we come against this all the time. Sometimes it's in the marketing department, or it sits in the communications or shareholder or investor affairs or whatever it is. But I have my view about where it should sit in order to be properly embedded and integrated into an organization. Please share with us what you think about that.
I like Sean's response to your question, and I'll touch on some of the points he raised as well. So the short answer is that it should sit everywhere. Absolutely, it has to be run at the level of the board. The board has to be responsible ultimately for the governance of the company. And that's not just about compliance with King 4. It's not just about discharging responsibilities in terms of our company law. It's not just about the responsibilities in terms of listing requirements, but it's about the sort of the basic fundamentals of a sort of a human sense of duty to the broader group of stakeholders, and the fact that ultimately the board is the custodian of the company's relationship with those stakeholders and with the sort of broader citizenship body. But the board by itself can't really drive an integrated thinking philosophy. If the board has an integrated thinking mindset, and in my opinion, the board is just trying to impose that mindset on the different layers in the organization, the research we've been doing suggests that you're going to come up with all sorts of resistance. So it very much has to be a type of organic process. And I know that sounds a bit cliched, but nevertheless true. Yes, the board has to take responsibility for this concept of integrated thinking and value creation, But at the same time, the key members of the organization who might not necessarily be on the board also need to have that sense of commitment. They need to understand how do all of these environmental, social, and economic issues fit into the strategy. And I like the fact that Sean touched on the link between ESG and strategy. He hasn't framed it as something separate. He's made it very explicit that the ESG is an integral part of that strategy, and that in turn gives rise to innovations and opportunities for differentiation and competitiveness. So then the question is, at an organization, how do you then take those principles and get the rest of the staff complement to start thinking creatively, to start realizing that this E, S, and G component are really just 3 additional dimensions in the value creation model, and that we shouldn't be seeing them as compliance-based issues, as just reporting issues. We should be seeing them in terms of the risks that they give rise to, and at the same time, the opportunities which they create, and the way in which we can take those risks and manage them, or take those opportunities and capitalize on them in order to create value. And I'm really pleased that Sean mentioned the fact that we make lots of money. I actually wrote that down. I'm really pleased that he mentioned that, because a lot of people seem to think that ESG is about making profit a dirty word. We're not saying that at all. Companies should make a profit. They should make huge profits, super profits, and they should distribute massive dividends to their shareholders. That's great. But what we're saying is that that needs to be done within the context of sustainability. It needs to be done responsibly, morally, and mindfully, and in a way in which you enrich your shareholders, but at the same time, you provide benefits, direct and indirect, to all of the other constituents without whom you would not have been able to generate those super profits in the first place. And again, it comes back to the point of saying, to achieve that, yes, the board must be the custodian of ESG. Yes, the board must be the custodian of integrated thinking, of integrated value creation. Yes, the chief executive officer and the chief financial officer should be the CVO. But you have to have the buy-in of the rest of the organization. Otherwise, the board has to keep pulling everybody kicking and screaming towards this sort of new idea of value creation and this multidimensional logic that we keep talking about.
Excellent, thank you. So I agree with you. I think the whole idea around strategy, I mean, most business plans that are developed by strategists inside companies are based on outdated information, not on the future climate, not on the current socioeconomic issues that need to be addressed through shared value. So I 100% agree that strategy, when I see sustainability sitting in the strategy department and integrated into the strategic roadmap of an organization, it gives me a warm, fuzzy feeling, I have to say, because I know that the right components are being taken into consideration. Loshni, I'd like to ask you a question. How much buy-in and engagement are you getting with your membership of SAICA, as well as your colleagues, in adopting the wider view of things? Or what are the major barriers, and what is SAICA's strategy to drive awareness and advocacy to allow us to get over these things? How do we overcome these barriers? What's happening at SAICA?
So if you asked me this question about a year ago, my answer would probably be very different. With advent of COVID and lockdown, the topic sustainability, climate has it's accelerated. You can't open a newspaper without some article around climate or sustainability, featuring as a major topic. So from a SAICA perspective, and I'll start with the membership base, I've seen over the last 6 to 8 months, there's an increased awareness, there's increased engagement, there's a lot more questions coming from our membership base around what is sustainability, what is ESG, how do I look at this, how do I think about this, how do I incorporate or respond as a company, what am I supposed to do? And this is across all levels of our membership base, from our CFO levels right down to junior accountants, students coming through university, about to get to board. And that's amazing. I mean, I'm loving it, because for the first time, it's not where I am trying to get accountants and future accountants to start thinking about these topics and engaging with these various aspects. It's a pull. It's where I am actually being asked, well, what are we doing? What is SAICA doing? How do I engage with this content? So from a SAICA perspective, and I've got some really exciting news, which is seriously hot off the press as of yesterday. And it talks to SAICA's strategy and where we're going and why we are taking sustainability so seriously. But let me get back and wrap up the membership part of it from an advocacy and thought leadership. So we do have a lot of content out there looking at various aspects or themes under the broader sustainability space. And we've revamped and we're busy revamping our website. So a lot of the content is available, freely available to members and broader audience in terms of trying to engage with certain content. And it links to, for example, our CPD process, which is, as Sean and all of you and Warren should know, it's more a reflective process. So, we're trying to put content to help you understand climate risk or health and well-being, and as well as research around assurance of the various themes, as well as reporting. We've also built it into our in terms of our CPD process, our competency framework. So you'll find from a competency perspective, whether it's behavioral or technical aspects of corporate citizenship is part of that conversation. So, it's trying to support our membership base from a pre-qualification as well as a post-qualification. The hot of the news press. So from a psycho perspective, the two really, really important things is I've got permission and I've got approval. Permission's the wrong word, approval is the right word, is to establish a sustainability technical committee. And there's been quite a few drivers around that. But one of the key things, as an example, is the IFRS Foundation setting up that sustainability standards board. Now we have various committees that from an advocacy point of view, write comment letters and try and advocate on behalf of accountants and the broader South African society. Now, our current committee is made up of accountants with, and this is not, I'm not trying to be offensive in any way, but a wonderful IFRS specialist. But with the establishment of a sustainability standards board, we need people with a greater diversity of skills, experience, who understand these various sustainability themes. So one of the responsibilities of this committee is to be the central force that actually responds to these comment letters and position statements and advocates on behalf of SAICA and members around sustainability type topics. So I'm very excited. I'm really thrilled that, after so many months of work, we actually going to get this off the ground. The other key component, key aspect from SAICA is, and we talked about it now, about strategy, where sustainability has to be integral as part of that strategy. So as part of that process, what I'm currently working on is trying to bring sustainability themes, topics as part of our SAICA strategy. So it's not a separate conversation, but it's part of and integral to what we do as SAICA. Sorry, I might have run over that 5 minutes in my enthusiasm.
No, it's fine.
But if you want me to expand on anything, please do.
Please just expand. Just take your time. I think this is quite an important thing, and thank you for the announcement on this particular webinar. So please finish off the way you want to, Vash.
Maybe one of the examples that I can share around the enthusiasm and from our membership base, we now have a quarterly newsletter that that goes out to our members. And what the quarterly newsletter is trying to explain is it's not just an information dump. So you know what, IFRS Foundation has released a comment letter. Please, you've got 90 days, submit a comment. Or the National Treasury has the taxonomy out. You've got 15 days, please submit a comment letter on it. That's not the point of the newsletter, because what we've been asked to do is, okay, tell us what's happening in this space and tell me why it's important to me and what do I need to do about it. So we're still experimenting with the newsletter, but I think this for me has been one of the good things from our membership base, because here's our members asking us, tell me why and tell me what I can do. And we've got a whole lot of other projects and programs, and one more shout out. It's our sustainable essay project that has been created from our accountants and the young accountants. So what they are doing with this project is on a monthly basis, they're taking each of these sustainable development goals and they're putting out content out there, whether it's articles, webcasts, podcasts, so that you can go and take a look, read, listen to, and understand what is that SDG is about, and how can I do something about it, whether I'm a company running my own business, whether I work as a corporate or as an individual. So a whole lot more, but I'll stop there. Thanks, Kevin.
Lashni, thanks. Sounds very, very exciting, and I can feel your passion as well. So it seems like I've got the right person driving this at Syca. Sean, in the last 2 years, ESG has grown up, and by this I really mean it's not just about talk and it's not just about theory, but in South Africa, we've seen a whole range of initiatives from all different kinds of companies, lots of them in the real estate sector. I see there was one from Netcare in terms of bonds and loans being raised that are the allocation and cost of which are being aligned with ESG performance within companies. I believe you guys have done something at SA Taxi as well in the same theme. Please tell us a little bit more about this and give us your opinion on where this is going. Is this going to be something that it's starting off as something that differentiates, but eventually it'll become licensed to operate in the financial world? What is your view on these particular initiatives, Sean?
Kevin, so yes, we issued a social bond, probably about a month ago. It was by value our biggest securitization to date. It was around about R1 billion, a 10% sort of equity underpin to that, which is our lowest equity underpin, and I think it was JIBAR plus 174 basis points. Excuse me if my dog is barking in the background, the joys of working from home. Which again was one of our lowest rates, and actually since COVID, it was the first time we were able to tap the capital markets. So almost the first time for a year we're actually able to tap capital markets. So yes, I mean we've issued one. I saw on LinkedIn last night that Standard Bank, I think, have just issued a R2 billion social bond that came out last night, and there are a number of examples in the social and environmental space around this. My sense, Kevin, actually probably my hope is that allocators of capital ultimately will enforce this kind of change. We see it with some of the big funds offshore who have sort of sold down holdings of oil and gas companies, sold down holdings of coal companies. We saw it with the court case in, I think it was The Hague, where Just Share and the like sort of forced, I think it was Shell, to move their targets to 2030 as opposed to 2050. So I think capital allocators will drive this. At the moment, yes, you could say it probably is a differentiator. I imagine in time it'll be a license to do business. You know, just like your financial scorecard or your financial health is the way you issue bonds, issue equity, get debt capital from banks. I think that's the way it's going to go. And I think, quite frankly, the sooner the better. It is a way that will force people to do more of the right thing. So that's what I see. Again, in our world, we are a little bit different. Obviously, we are a non-banking financial institution. SA Taxi sort of lend clearly to South African entrepreneurs in the taxi space. We fund ourselves through securitizations, we fund ourselves through bank debt, and we fund ourselves through DFIs. And the DFIs mainly are from Europe and America. I think there's one from Canada, and they really do help in all sorts of instances. One of them is the dislocation of financial markets, which we saw through COVID, and I guess we would have seen through the global financial crisis. So we use this kind of funding all the time, but now it seems to be becoming way more mainstream.
Excellent, thanks, sir. Thanks, Sean. So my next question, which I'm going to actually put to Warren, and it's a little bit of a plug from GCX, because as you know, we're a sustainability solutions company focused very much on big data around ESG. We've got a software as a service platform that helps companies with disparate, decentralized, and basically chaotic data sets from all over the show. Not easy to consolidate, not easy to make sense and add value to. The financial accounting profession is really blessed with having very mature enterprise software to manage all this stuff. Okay, and I think one of the things that accountants really get overwhelmed by is that the default for most massive companies in managing non-financial and the financial data associated with sustainability is still run on spreadsheets. Okay, we obviously know the drawback of that. Warren, what is your view? Because if we do not have the correct measurement tools companies are going to continue to struggle to manage and improve this issue and to be able to provide verified, reliable data to investors, financiers, etc. How do you see this space evolving, Warren?
So that really gets to the heart and soul of it. And that is what, in my opinion, and based on the research we've been doing, that's what differentiates companies which engage in actual integrated thinking and then just report on it from the guys who are operating as normal and then just go and prepare a separate integrated report that looks nice and glossy. It comes down to what we like to call the actual accounting and management infrastructure. Now, when it comes to collecting data, that really is the question, because we can talk about ESG for hours on end, but how exactly do you want to go and measure that? What data do you want to collect, and how do you want to structure that data? And how do you know that that data actually reflects the real environmental or social or governance-based performance? The short answer is that we don't have the answer to all of those questions. There's no generally accepted view on it. So when it comes to accounting and finance, you're quite correct. We've got fantastic, elegant models that we can use to extrapolate and interpolate discount rates. They're mathematically grounded. When it comes to the actual accounting, we've got IFRS. While people have mixed views on IFRS, it provides a very comprehensive basis for accounting for transactions and framing the way that you ought to do the accounting, the type of data you need, and how to present that data. When it comes to the ESG side of things, it's far more flexible and far more dynamic because we're not entirely sure how to structure all of that data and how to collect that data. So what we're seeing at the moment from companies grappling with integrated reporting and thinking is that it's very much being done on a trial by error basis. They are aware of the sort of pressing issues that are facing their business at the environmental, social level. They try to collect data that they think helps inform their decision making and ultimately use that data to inform what they're including in their integrated reports. These types of companies also have reasonably developed controls in place over that data collection process. And we're also starting to see the ascendance of assurance, formal, internal, and external sources of assurance over those data and control systems, which talks to your point about the accuracy and the reliability of the information being reported to investors. But ultimately, there isn't a single source that you can go to which says the chart of accounts for ESG thinking or integrated thinking looks like this. This is the double entry system which you use to account for it. The other, of course, big issue is, remember, and I think we've spoken about this before, it's not a case necessarily of taking all of this information and just capturing it in rands or dollars or yen, whatever your functional currency happens to be. Because we're working in 8 dimensions with all of these different types of capitals, or 6 dimensions, we're effectively dealing with 6 different currencies, to use the term loosely, that we need to think about. And exactly how you measure the environmental and social items, the actual unit of measurement. Is it rands? Is it quantity of carbon? Is it volume of water? Is it the number of tweets? The exact unit of measure is very much up for debate and hasn't actually been resolved yet. And I think that what we're going to see as people become more comfortable with different data solutions and the use of big data in particular, I think we're going to start seeing different approaches being used to constructing data sets and analyzing the data sets. But I think it's very much going to be a case of driven from principle and practice, and then giving rise to some type of formal standard which informs how we do things. And I say that because if you look at our IFRS, that's very much how it started. We used to have a sort of a generally accepted approach to accounting for different types of financial transactions. Over time, that sort of coalesces into a set of 2 or 3 dominant practices, and eventually that gives rise to a formal standard. And I think we're going to be seeing something very similar happening when it comes to the integrated thinking and reporting environment.
Thank you. Thanks, Warren. Sean, quick feedback on this and how you're currently doing it versus how you would prefer to be doing it.
Yeah, so I think Prof. Warren is exactly right. So what we do is, depending on what it is or what our measure is, some of that is systematized and some of it isn't. Things like getting a baseline, a carbon baseline, that's is sort of new to us. That's run off models. The feeds into models are some of them are educated guesses, some of them are real data. So where we can, Kevin, we spent the last 18 months, the first 6 months of that 18 months was to develop a framework That framework we ultimately mapped into SDGs just because it was, something to hang our hat on. We looked very, very closely at where we can make impact, both positive and negative. So we didn't try to be all things to all people. And then where we've been able to, we have populated our ESG data or our sustainability data into certain systems, but absolutely, it's some of it in spreadsheets. The verifiability and the repeatability of it is probably where our biggest issue is going to be as we go forward. And then how you assure that. Again, I think you started off talking about cost around this. I mean, do I really want to be paying Deloitte or KPMG whatever sort of rand amounts to audit, sort of environmental or social data, or is there a combined assurance model which works better, or is it just repeatability of models that people are after? So all of these things are things we're grappling with. It's not easy. It is messy, but that's how all these things start, I guess. Probably no different to how accounting and management information systems start, quite frankly.
Absolutely. Thanks. No one said it was going to be easy, Sean, but we're doing it. Loshni, I can see you feeling left out, so I'm going to come back to you because I wasn't going to ask this question, but it has been put into the chat. So it's a sign for me that I need to ask you this question. The accounting and auditing profession came under fire a lot lately in not picking up irregularities around ESG metrics that should have been maybe flagged due to poor governance. Tongard, Steinhoff, EOH. At what point do you believe that the profession actually needs to be held accountable for doing, I suppose, what they are paid to do, which is to pick up these irregularities before they happen and maybe take accountability for them after? What is your view on that, Loshni?
So I think I want to start off with, let's acknowledge that there's been these irregularities, these incidences of fraud, and we need to hold people accountable. And as SAICA, we do take this very seriously. And I can't speak about the cases, but I mean, there's a lot in the public domain in terms of what we've done from a disciplinary process and holding members accountable. We have 40 something odd, I think it's 46 something odd thousand members, and it's not everyone, it's not every single accountant that is unethical and corrupt or whatever it is. But we do take this very seriously. And there's a couple of examples that I want to demonstrate, that I want to use to demonstrate, how are we responding other than just the disciplinary processes and trying to hold through those processes, holding members accountable. We've launched quite a few programs in the last, I think it's year and a half. The biggest one is the ethics program. We have a whole host of interventions, engagements, and looking at how can we support our members who want to whistleblow, who have challenges in organizations when they come across incidences of fraud or corruption. How do they deal with that? We have a query system where members do call in and speak to our legal and governance experts and say, okay, this is the challenge I'm facing. How can I respond to this? The other two big projects that we have is around the reporting aspect as well as the audit and assurance aspect. Because rightfully you were saying, maybe the auditors should have picked things up, or maybe the report preparers should have disclosed better. So the two projects are looking at engaging at a very broad level and trying to understand what are the specific challenges both in the reporting ecosystem and in the auditing ecosystem, and how do we as SAICA and its membership base respond to try and resolve those issues and those challenges. And I do understand the concern in terms of, well, how do we, if this is happening in the financial reporting space, what does this mean for the sustainability, the ESG reporting space, where we, it could translate into those spaces. And it talks to some of the work that we're doing from an advocacy and thought leadership space around sustainability to try and give our members the knowledge, the tools, the skills on a continual basis to engage with these sustainability topics. And I think the thing is, and I just want to end here, is that yes, it is a mess, but we need to work together to try and resolve these issues, and try and, we have collective wisdom, we have a range of skills, knowledge, and it's trying to bring all of that together to be able to solve all of these problems. And I want to end it at that point. Thanks, Kevin.
Thanks, Loshni. Thank you. Not an easy discussion, but certainly one that you have dealt with elegantly. Thank you. I suppose my question now, there are one or two. Sorry, thank you also to David Lipschitz from my power station for fielding that question. I want to speak to Warren now. Warren, if you don't mind, this concept of the CFO's role changing from a chief financial officer to a chief value officer, can we unpack that a little bit, please? Because one of my key comments that I've made over and over was that accountants understand the cost of everything, but struggle to understand and quantify the value of everything. And I know that that's probably not a fair statement, but I'm going to pose it to you if you just don't mind unpacking it and giving me your view of things on that.
Kevin, I think it is a fair statement, because if you actually look at the way we've thought about accounting and finance and the way we've taught accounting and finance graduates, and I'm not now talking about the last 10 years, talk about the last 200 years, we've been thinking about accounting and finance in a very myopic way, about rands and cents and revenues and costs and marginal cost and marginal benefits. And economists function in a very similar way, by the way. So this idea of integrated thinking and value creation is, in my opinion, really being driven by a whole host of externalities that are coming from outside of the accounting and finance profession. Climate change has been around in the scientific literature for quite a while, but it's only really in the last sort of 10 years that it's really starting to be internalized, or starting to become internalized as a business consideration. The same applies to all of the other environmental and social challenges which we are facing. And if you look 50 years ago and you talked about sort of global pandemics, disease management, accountants would have told you that that's something that belongs firmly in epidemiology. And yet here we sit today with COVID-19, which is a biological issue, causing massive business problems. So I think one of the reasons why we have this sort of struggle in trying to get our head around moving from cost to benefit is because we've been doing that for so long. And all of these new principles, new threats, new issues that are beginning to emerge are all new. They're all things that we haven't dealt with before, that we don't necessarily have tools to deal with. And it's a case very much of modifying what we know, carrying out research, conducting experiments, doing things by trial and error, and sort of grappling with problems to find particular solutions. So that's the first part of it. The second part of it is then to say, all right, well, how do we now have this sort of transition from CFO, CEO to Chief Value Officer? Why is this taking place? So there's sort of two schools of thought. The one sort of group of people with whom we've been engaging from a research space are the people who intuitively have realized that social and environmental issues are not so-called soft issues. They're actually not non-financial. By their very nature, they're indirectly financial, but they're still material for the business. And these guys who are beginning to realize that these factors have to be incorporated into their risk management, have to be incorporated into their strategy, have to be incorporated in the way, for example, like Sean prices their financial instruments. These are the sort of people who are transitioning to this idea of a chief value officer, because they realize that there is this multi-capital environment in which they are operating. Now, some people understand those principles quite easily. They're capable of identifying the risks and opportunities quite easily. They internalize them and they modify the way they manage their businesses with relative ease. I'm not saying it's easy, but with relative ease. The other side of the coin are the naysayers. And I, by the way, was originally a naysayer. I originally thought this ESG and integrated thinking was really just impression management. And I sought out to test that empirically when I was doing my research. It was proven wrong. Now, for the naysayers, I think that the transition to the chief value officer is almost inevitable. It's just a case of them not getting there by themselves. But the simple reality is, environmental and social problems are not going to go away. They're going to actually get worse. The environmental threats which we're dealing with are going to be amplified, unfortunately. The science is telling us climate change is here. There's nothing really that we can do about it. It's about minimizing the damage. Social inequality in South Africa is a major problem. These insurrections that we've been seeing over the last few weeks are just an indication of that. And unfortunately, the scientists are also telling us that this is not the first time we're going to have to be dealing with a global pandemic. There's going to be another one. So the reality is, whether you believe in this or not, your business is going to be threatened by environmental and social externalities. And you've got two choices. You either manage them and adapt, or unfortunately, your going concern assumption is going to become questionable. Even if we don't face some kind of catastrophic threat at that level, we are seeing a massive shift in the way financiers are starting to think about ESG issues. The big allocators of financial capital have started to see that environmental, social, and governance factors are important financial considerations. And as these guys start building that into their own valuation models, into their own investment appraisals, I'm of the opinion that they're going to be placing a tremendous amount of pressure on companies to start thinking about these issues. And in doing so, they're going to inevitably lead to this transition towards the chief value officer. So the position that we've taken is, if it is inevitable that we're going to get there, you might as well sort of accept your fate. If you were originally a naysayer, start opening your mind to these ideas and see if you can't build on your existing skill sets to transition naturally to a chief value officer, rather than waiting for a large institutional investor or some type of stakeholder activist or some type of externality, like an environmental crisis, to force you to transition towards thinking about multi-capital value creation.
Excellent. Thank you. Thanks so much, Warren. That's a fantastic response. I have a question from David Frank from Nedbank, which I quite like, and I'm going to just, if you don't mind, Loshni, just handling this one. How do standard setters such as IFRS balance the standardization and comparability of data with the flexibility that companies require when grappling with their unique ESG impacts? And how do we then ensure that the data that is reported is verifiable and accurate? If investors begin to use ESG reporting at the forefront of capital allocation decisions, there will be significant incentive for companies to be creative in their reporting. Is this whole ESG just the start of another creative accounting phase of our lives, or do you see this as something that can be well managed?
The first part of it around, I'm going to use the IFRS Foundation with setting up their sustainability standards board to try and respond from a reporting perspective. The comparability aspect of the ESG data, that's been an issue, and then that has been one of the talking points in terms of moving towards a consolidation or rationalization of these various ESG reporting frameworks. Because the criticism has been, because you've got so many different reporting frameworks, the way you report, you can't actually compare across industries or even within industries. When investors look at the disclosures, you can't actually compare within companies or companies across years. So that is, as I understand it, when we talk about the IFRS Foundation and the establishment of the Sustainability Standards Board and the intent of creating sustainability standards against which companies will use to report their ESG sustainability information, one of the aspects of those standards is to try and resolve this comparability issue. Because there would be, hopefully, because you're reporting against a specific standard, the companies will be reporting in a certain manner. Now, I don't know. And that's why I think when I started the whole conversation, my opening remark was this wait and see. Because I think we are also placing a lot of pressure, or we have a lot of expectation in terms of what these standards are going to come out and how they are going to solve a multitude of problems that we experience when we look at sustainability and ESG reporting. And I don't know, personally, I don't know that they're necessarily going to solve everything. And again, I'm saying wait and see. Let's see what the first round of standards come out. We comment, we try and influence, and we try and change it so that it responds to what we require as report preparers and as users of this information. I'm hoping I'm trying to answer that one. I'm hoping that kind of explains where I'm going with the reporting part of it. And then from an assurance aspect, and I think we've touched on this a bit, in South Africa, I think it's about 40% of the listeds actually do assurance over their ESG information or the sustainability information that's disclosed, whether it's in the integrated reports or sustainability reports. Now, there are challenges around that. There are standards that help the firms, but there are challenges really around assurance. But there has been some work done globally by the International Accounting and Assurance Standards Board. I'm hoping that's the right IAASB, where they've tried to put guidance out for assurance providers around looking at, well, how do you provide assurance? What are some of the issues around the standards that provide the assurance providers with better guidance in terms of how they execute these projects, how they look at engagements, how they look at the specific information. And very recently, IFAC has released global research around assurance. And I'm not saying that necessarily whether you do external or internal assurance or use a combined model, you can tick that box and say, okay, all of this information is accurate, it's complete, it meets all of those requirements. I think it's more a holistic approach in terms of how companies look at that information, how they put it out there, because I think the primary responsibility comes back to the companies in terms of making sure that the information that they collate, they report on is accurate, that people who use this information can place some level of comfort or reliability. But it doesn't take away that any assurance provider, whether you're looking at specific environmental information or you're an accounting firm, you have a responsibility to follow the standards and the guidance to make sure that the users of this information can place reliability. But there is guidance out there, and there is a lot of work and a lot of focus going in on assurance.
Okay, thanks so much, Loshni. So I'm going to start rounding off the conversation. Yes. Sorry, I thought I heard something. I'm going to start rounding off the conversation. I see Sean is having a couple of tech issues. So Sean, let's try. If it doesn't work out, it's not the end of the world. We've had such good insights from you already. But the question to each of the panelists in no particular order, if you don't mind, if we have the same webinar in 5 years' time, and I've done this before. I had a thing on sustainable finance 6 years ago at the Table Bay. We did the webinar again, and we look back, and hindsight is a beautiful thing. But if we did this in 5 years' time,
yes.
Sorry, Sean, I think we're hearing you, but not hearing you. If you can just mute, perhaps. I'm not sure. Sorry. If we have the same webinar in 5 years' time, how's it going to look by then? What are, through our different lenses that we've identified today, what are we going to be saying from an academic perspective? Warren, please.
I think we're going to have a mixed bag. I saw a comment pop onto the screen while you were busy chatting, somebody saying something to the effect of, we can't adopt the wait and see, we can't wait for standards. And I agree with whoever that person is. I think that some companies, some entrepreneurs, accountants, financiers are really going to take a lead in this. They're going to see the opportunity to differentiate. They're going to see the opportunity to bolster strategies, to mitigate risks, to capitalize on value creation. And I think that those companies are going to play a pioneering role. We'll probably find those companies developing these systems that we were talking about. They might even inform the next set of standards or the chart of accounts that we're going to be using to talk about and describe and explain ESG issues to various stakeholders. So I think that there's some optimism. But at the same time, I also think that there is reason for concern. I think that quite a few people are going to adopt a wait and see philosophy. It's very much a case of saying, oh, well, let the ISB and its new sustainability standard setting board, let it go and figure out how to do all of that. And once they've done that, then I'll go and I'll get somebody to try and help me do all of these things that everybody's been talking about. Similarly, there are still people who are not entirely convinced that things like climate change and social inequality and so on are actually valid business threats. And they also adopt a wait and see philosophy to sort of test to see if this idea of the chief value officer actually yields the type of benefits that everybody has been talking about. And that really comes down, in my opinion, to the fundamentals of human nature. There are just some people that sort of see an opportunity or see a risk and act on it. And there are other people who, for a variety of different reasons, tend to demonstrate a lot more inertia. And unless there's some sort of major catastrophe that drives them to do something, they will continue to sort of go on in exactly the same way. So I think we're going to have a mixed bag. The only thing that remains to be seen is the proportion of preparers and businessmen, businesswomen who fall into those two categories.
Warren, thank you. Loshni?
So I want to put kind of a disclaimer on the wait and see. So my wait and see response is really around reporting and assurance. I want to take it back to some of the what I'm seeing in forums and the questions that we get. It's where the question that we always get is, we need certainty around policy, legislative, and regulation. And we're going to wait to see what happens. And my response to that is, we can't wait to see what happens. As a company and as an individual, like you've said, Warren, climate change is here. This is our reality. So at this point, if you don't have a strategy, if you don't have a response to all of these environmental and social risks at this point and coming down the line, then, well, you're kind of irrelevant, honestly. Whether you report, and this is a personal stance, whether you report or don't report, it's what are you doing now? So in 5 years, I think this conversation, like Warren says, is going to be a mixed bag. I think those who are looking to the future, who are thinking about, well, tomorrow, 5 years, 10 years, 20 years, are going to be in a better position because they will have better responses. But the ones who are still thinking that the floods in Louisiana, the floods in China are just, well, it's one of those things, are going to be left behind. So I think I do tend to agree with Warren that we're going to be somewhere in the middle. And I'm hoping that most companies are going to be, let's respond and let's do something, and we'll figure out the reporting and the assurance later, but let's respond. Thanks, Kate.
Thanks so much, Loshni. Thank you so much. I see that Sean has unfortunately succumbed to technical issues, but as I said, his insights have been fantastic to date. So let me just conclude with the following. I think it was, and I often cite the story of my interaction with Professor Mervyn King about 8 years ago at one of these events where I was just beside myself with frustration, dealing with mostly laggards in the South African space who refused to acknowledge that there was even risks associated with this stuff, climate change, etc. And I appealed to Professor King at the time to say, well, listen, why is this stuff just not legislated? We're talking about 40% of companies are currently being verified. Loshni, to your point, why is it just not that 100% of companies have to be verified? And Professor King said something that it's always rung in my mind, and it's actually playing out today. He says that legislation does not solve problems, but market forces put pressure on companies that they cannot actually escape. And I think what we're feeding today in the market, and certainly along a lot of my clients, is this division into leaders and laggards. We can see that in order to be a leader, you need to be proactive, you need to have a sense of what your strategic roadmap looks like into the future, and you need to have a proper way to implement it as per good business practice. To be reactive right now is costly, and it's going to become costlier and more expensive. And I have a sense that the leaders are the ones that are just going to survive, and the laggards are just not. So I think it's on that note that I have to really say thank you to all my panelists who I think have taken their time to prepare and also to be during this panel discussion, to our audience. And I think there's quite a lot of you out there. There's between 70, 80 people watching this webinar. I hope that you've gleaned some great insights from it. If you do have questions, and I'm sorry that we haven't answered all of them, I will make sure that those questions go to the people that you've directed them at. But for the most part, this is a topic that and the debate that's going to continue. So I am very, very grateful to my panelists, and I'm very, very happy that we actually took the initiative as GCX to actually conceptualize this panel discussion. And I'm very, very pleased with the outcome. Thank you so much to IDNA for facilitating this discussion in terms of the marketing and the comms, and to my team in the background for doing what they do. Thanks, everybody, and I wish you all a beautiful day.